Today is Friday, February 13th, 2026, 13 days after silver hit $121. And right now, at this exact moment, silver is trading around $75. Your phone is exploding with panic alerts. Your group chat is flooding with doomsday predictions. The bears are celebrating. The trolls on Reddit are declaring victory. And 99% of silver investors are making the same catastrophic mistake. They think this is a crash. They think the rally just died. They're wrong. Mathematically, structurally, fundamentally wrong. Because if you wipe the emotion off your screen and actually examine what's forming on this chart, if you study the mechanics of what China is doing behind the curtain right now, you'll realize that this drop to 75 is not the end. It's the final trap before the vertical launch. What I'm about to show you is not opinion. This is forensic market analysis. This is the anatomy of the most powerful bullish reversal pattern in technical analysis, carving itself into the chart in real time. This is the exposure of a hidden Chinese tax loophole that's been flooding scrap silver into the market to hide empty government vaults. And this is the proof that while you're panicking, smart money is backing up armored trucks. Because they see what you don't. The right shoulder of an inverse head and shoulders. The final shakeout before 88 breaks and the squeeze detonates. Let me start with the chart because this is where amateur hour thinking gets obliterated. Most people think bull markets move in straight lines. Green candle after green candle until you reach the moon. That's fantasy. Real sustainable bull markets are built on architecture. They're built on progressively higher lows that prove sellers are running out of ammunition. And that architectural blueprint is being painted on your screen right now. Go back to late January and early February. Remember that first drop? When price cracked under selling pressure and found support around $74? That was the left shoulder. The bears were aggressive. They thought they could break the spine of this market. Then came the center formation, the head. This was the panic event. Maximum fear concentrated into 72 hours. The price violated 74. It went into absolute freefall. Capitulated all the way down to $64 in a V-shaped bottom that terrified every leveraged trader on the planet. That was the system purge. The algorithm hunting down every stop-loss order. Every weak hand, every over-leveraged position that couldn't handle volatility. It flushed the toilet completely. And then what happened? It rebounded. It didn't gently recover. It rocketed vertically back up. Reclaimed 70, reclaimed 80, reclaimed 90. And now, right now as we speak, we're carving out the right shoulder formation. This is the single most critical component of the entire pattern. For an inverse head and shoulders to trigger properly, the market must pull back one final time. The bears have to test the conviction of the bulls. The sellers throw one last punch to see if buyers will flinch. Today, they threw that punch, dumped millions of paper ounces onto the market, tried desperately to drive price back down to 64 where they could declare total victory. But did they succeed? Look at the intraday low. It bottomed at $75.03. Do you comprehend the significance of that number? 75 is higher than 64. It's even marginally higher than the left shoulder at 74. This is a higher low. This is the market screaming at you in mathematical language that sellers are weaker today than they were 2 weeks ago. 2 weeks ago, they could push price to 64. Today, they can barely shove it to 75. They're exhausted. They're running on fumes. Every time they attempt to slam this market, buyers step in at an elevated price level. The bid was at 60. Now the bid is at 70. Now the bid is at 75. The floor is ascending underneath your feet. So when you see 75 on your screen and feel that knot of fear in your stomach, don't interpret this as weakness. Interpret this as the right shoulder. Interpret this as the coiled spring being compressed one final time before explosive release. The energy is accumulating. The pattern is tightening. The neckline sits precisely between $84 and $88. That zone is the trigger mechanism. Once this right shoulder completes its consolidation at 75 and buyers regain control, the technical target is not a simple return to previous highs. The measured move of an inverse head and shoulders is calculated by taking the vertical distance from the head to the neckline and projecting that distance upward from the breakout point. Distance from 64 to 84 is $20. Add $20 to the 84 breakout level. That calculation yields a technical price target of $104. That's where the mathematics of this pattern are pointing. That's the destination encoded in the structure. But we can't be reckless. We have to be surgical. We have to monitor critical levels with precision because this entire bullish scenario depends on one number holding firm. $74. This is the line drawn in sand. This is the foundation of the right shoulder. If daily closing price remains above 74, the pattern stays valid. The bull market stays alive. The squeeze mechanism stays armed. This is the accumulation zone. If you're searching for ideal risk reward to add to your physical stack, this is the moment. You're buying at 75 with a technical stop at 73, risking $2 of downside to capture $30 of upside. That's a 15 to 1 risk-reward ratio. Professional money managers would kill for that setup. However, we must acknowledge the danger zone because respect for downside risk separates us from degenerate gamblers. If bears somehow manage to fracture 74, if they close a daily candle below that threshold, the pattern invalidates, the right shoulder collapses. And if that structural failure occurs, the trapdoor opens. If 74 gives way, there's minimal support until we retest the head formation at 64. We revisit the lowest point of the panic. That's the risk profile. I'm not telling you it can't happen. I'm telling you what to watch and how to respond. If we break 74 and plunge towards 60, that's not a moment to sell in terror. That's a moment to back up the armored truck. That's a generational wealth transfer opportunity where you liquidate non-essential assets and buy every available ounce of physical metal. Because at $60 silver with Turkey vacuuming up 13 million ounces and China banning exports, you're witnessing the greatest asset mispricing in financial market history. You're being handed free money by terrified amateurs. $60 is production cost for marginal mines globally. Below 60, mines shut down operations. Supply goes to absolute zero. So 60 represents the hard floor constructed from economic reality. Here's your tactical roadmap for the next 72 hours. We're sitting at 75. We're watching 74 like a sniper watches a target. If it holds firm, we ride the wave to 88. If it fractures, we wait for 60 and acquire everything in sight. Either route leads to the identical destination. The only variable is the path. One path is the express flight. The other includes a layover in purgatory. But both aircraft fly to the same terminal, the moon. Now that explains what the chart tells us. That explains the technical architecture forming in real time. But there's a deeper question gnawing at every silver stacker right now. A fundamental contradiction that doesn't compute if you only consume mainstream headlines. We know there's a shortage. We know mines are depleting reserves. We know Turkey is acquiring record amounts. India is operating as a vacuum cleaner. So why is price not at 100 already? Why are we witnessing these periodic slams down to 75? Why does fresh metal seem to materialize out of thin air precisely when the squeeze is about to detonate? To answer this, you have to redirect attention away from where Western financial media wants you to look. You have to examine the plumbing inside the Chinese internal market. We've received intelligence from analysts who actually comprehend metal flow on the ground in Shanghai, Beijing, and southern industrial zones. And they've exposed a concealed mechanism Beijing is deploying to keep this game operational. It's called the silver seesaw, and it's the reason price is being controlled even as physical inventory approaches zero. You must understand how the Chinese silver market is architecturally designed because it's fundamentally different from Western markets. In the West, we have one price, spot price. That's it. In China, there are effectively two parallel markets. There's the official market operated by Shanghai Gold Exchange, known as SGE. And there's the unofficial market run by thousands of small-scale recyclers, jewelry shops, and industrial scrap dealers scattered across every province. The relationship between these two markets determines global equilibrium price. Let me explain the official market first. When you purchase a standard 1 kilogram bar from Shanghai Gold Exchange, you're buying a VAT-paid product. China imposes a value-added tax of 13% on precious metals. That means if spot price is $70, the real cost to extract that bar from the vault and take possession is significantly elevated. Normally, SGE releases fresh metal from central government stockpiles to maintain market liquidity. When SGE is open and flowing freely, premiums remain stable. Official supply dominates price discovery. This is the left side of the seesaw, an equilibrium position. But what happens when SGE runs completely dry? What happens when, like right now at this moment, government starts rationing available metal for strategic defense industries and stops releasing bars to civilian public? Logically, you'd expect price to detonate. You'd expect premiums to spike to 50% over spot. But they haven't. Why? Because the right side of the seesaw just crashed downward with massive force. When official supply stops flowing, recycled supply floods the market like a dam breaking. This is the loophole analysts have identified and exposed. It's a quirk embedded in Chinese tax code that creates a hidden underground river of silver flowing beneath the surface. In China, there exists a tax exemption for small-scale taxpayers. If you operate as a small recycler, family-owned jewelry shop, or scrap dealer, and your monthly sales remain under 100,000 renminbi, which equals approximately $14,000, you're VAT exempt. You don't pay the 13% tax. You operate completely outside the tax system. Think about the economic incentive structure this creates. Right now, SGE bars are expensive and difficult to acquire because of government rationing. But street silver, old jewelry, electronic scrap, industrial waste is sitting dormant in hands of civilian population. And because these small dealers are exempt from tax, they can sell recycled silver into the market at a discount relative to official price. They can undercut SGE by 13% automatically. So when official window slams shut, scrap window explodes open. This is what we're observing in real time. The slam to 75 is not coming from new mining supply entering the market. It's coming from a tsunami of grassroots recycling activity. The Chinese public and small industrial players are seeing these elevated prices and liquidating scrap metal. They're stripping silver components out of decommissioned solar panels. They're melting down family heirlooms passed through 3 generations. They're flooding domestic market with tax-free metal that bypasses official exchange completely. This scrap flood functions as a pressure release valve engineered into the system. It kills premiums temporarily. It creates the illusion that plenty of silver exists, when in reality the country is consuming its own stored wealth. This is the seesaw mechanism in action. When exchange is heavy with inventory, street market is light. When exchange is light, like now, street market becomes heavy. Beijing loves this mechanism because it allows them to conceal true magnitude of shortage from both domestic citizens and international observers. It allows government officials to stand in front of cameras and declare, look, market is supplied, price is stable, there's no crisis. But what they're not disclosing is that this supply is finite. It has an expiration date. You can only recycle identical silver so many times before it's permanently embedded in industrial applications. You can only melt down grandmother's bracelets once. They don't regenerate. This is not new silver being mined from Earth. This is old silver being churned through the system like a washing machine on permanent cycle. And here's the critical insight that confirms bull thesis remains intact. This scrap flood represents the last line of defense. The fact that market is now relying on small-scale tax-exempt recyclers to set price tells you strategic stockpiles are gone. If SGE possessed available metal in their vaults, they'd be selling it aggressively to collect tax revenue. 13% VAT on silver transactions at these price levels represents billions of dollars in government revenue. The fact that they're stepping back and allowing scrap market to handle volume proves official vaults are empty. They're burning furniture to heat the house. They've run out of firewood. So when you look at the chart and see price struggling to break 80, don't assume it's because demand is weak. Demand is voracious. It's because hidden supply from tax loophole is temporarily filling the gap. But what happens when scrap runs out? What happens when low-hanging fruit of recycled silver is all sold and melted down? Then the seesaw breaks completely. Then there's no official supply and no scrap supply. And that's when you witness the vertical move. That's when price goes from 75 to 150 overnight without warning. But in meantime, this mechanism produces another effect critical for pattern completion. It cools down sentiment. It tricks retail investors in the West into believing the party is over. And we're seeing unmistakable signs of that sentiment cool off right now in the United States. We're seeing panic buying subside. We're seeing dealers relax operations. And ironically, this is exactly what the technical pattern requires to complete properly. We need retail mania to die down so smart money can take control of trade. We've received a major signal from one of the largest dealers in the world that confirms tourist phase is officially over. While Silver Seesaw in China is churning out scrap metal to keep physical supply on artificial life support, something very different and very important is occurring right here in the United States. The fever has broken. The panic has evaporated. For the first time in 3 weeks, retail silver market has returned to a state of eerie calm that professionals recognize immediately. We've received critical signal from largest precious metals dealer in North America that confirms tourist phase of this rally is officially concluded. COMEX. CEO Ken Lewis just transmitted communication to client database. If you remember back to late January during height of panic and sprint to 86, COMEX and almost every other major dealer implemented something unprecedented in operating history. They instituted mandatory order minimums. You couldn't buy 1 ounce. You couldn't buy 5 ounces. If you wanted to place an order, you had to spend $500 minimum. In some cases, for certain products, floor was $1,000. Why did they impose this restriction? Because they were drowning in volume, flooded with tens of thousands of microscopic orders from retail investors frantically attempting to enter market before it went to moon. Logistics infrastructure was collapsing. Shipping department overwhelmed beyond capacity. It was textbook retail mania event, a stampede. But today, stampede has gone home. Ken Lewis announced Apex has removed all order minimums completely. You can navigate to website right now and purchase single ounce if that's your desire. Shipping delays clearing from system. In-stock notifications reappearing on product pages. Volume of orders dropped off cliff. The silence is deafening. Now bears will examine this development and proclaim, see, demand is dead, rally is over, nobody wants silver anymore, it's finished. That's shallow surface level interpretation from amateurs. Professional interpretation is exact opposite. This cool off is the most bullish development that could occur for market structure right now. Why? Because retail investors are worst possible foundation for sustainable bull market. Retail investors are emotional, flighty, weak hands by definition. They buy at absolute top, driven by FOMO, and sell at absolute bottom, driven by terror. People who flooded APMEX last week are identical people who panic sold when price hit 64 during crash. They're tourists visiting market temporarily, and now tourists have exited building. What we're left with is sanitized market. People buying silver at 75 today aren't doing it because they watched viral TikTok video. They're doing it because they comprehend fundamental shortage at atomic level. They're diamond hands, stackers who've been here for years, accumulating through every cycle. And more importantly, absence of retail noise allows institutional whales to enter room without disruption. When phone lines at APMEX are jammed with 10,000 people buying 1 ounce each, the billionaire attempting to acquire 1 million ounces can't get through. Noise distorts price discovery, creates artificial volatility. Now that noise has vanished, smart money can operate. They can accumulate positions without triggering feeding frenzy that drives premiums to insane levels. So don't mistake silence for weakness. This is eye of storm. This is consolidation period, where metal migrates from weak hands who bought high and sold low to strong hands buying dip and holding forever. Sentiment has shifted from mania to boredom. And in investment universe, boredom is rocket fuel. When public gets bored, price stabilizes, volatility compresses. Inverse head and shoulders pattern has time to form properly without interference. And then, when nobody's watching, when forums are quiet and YouTube commentators have moved on to next trending topic, price rips vertically. And speaking of hype and delusion, we have to address elephant sitting in room making noise. While silver investors are meticulously analyzing risk, checking support levels, operating with military discipline and caution, cryptocurrency sector has entered phase of complete insanity. While we're examining downside risk to 60, crypto evangelists are telling followers that risk is relic of past that no longer applies to them. We need to talk about Michael Saylor. We need to discuss most dangerous sentence uttered in financial history. We need to compare arrogance of digital paper with humility of physical metal. While we're analyzing support levels with military discipline, cryptocurrency market has entered terminal delusion. Michael Saylor just told his followers they have no downside. No downside. In 400 years of financial market history, whenever a leader declares asset has no downside, the top is in. This is cult language, not market analysis. Saylor's telling you to borrow billions at low rates, buy volatile asset, and never face consequences because price only goes up forever. He dismisses risk as obsolete. Millions of retail investors, same weak hands who just left silver, believe they found money printing glitch. Compare that to us. Do we say no downside? Never. I explicitly told you if 74 breaks, we crash to 60. We respect downside. We prepare contingency plans. That's why silver is superior. Humility creates anti-fragility. When you know price can drop, you keep cash to buy dips. When you know banks manipulate with derivatives, you hold physical metal that can't be margin called. You're not leveraged like MicroStrategy. You survive winter. Saylor dies in winter. If Bitcoin drops 50%, which happened 5 times in 10 years, MicroStrategy faces existential crisis. Debt becomes unpayable. If silver drops 50%, we buy twice as much. Factories still need it. Missiles still need it. Atoms retain value regardless of paper price. This no downside narrative is ultimate contrarian signal. When crowds believe risk is abolished, risk returns with vengeance. When crowds are bored with asset, it explodes. We're tortoise. They're hare. Hare falls asleep drunk on hype. Tortoise crosses finish line. Don't be jealous of crypto green candles. Saylor sells fantasy. We buy reality. Finite supply with risk management. Physics beats fantasy. But to survive short-term volatility, we must be tactical. We must focus on specific numbers. We must watch 74 like sniper. So we've analyzed psychology. We've exposed China seesaw mechanism. We've laughed at crypto hubris and delusion. Now we need to enter tactical operations room. We need to stop discussing feelings and start discussing exact coordinates because in the next 72 hours, battle for future trajectory of silver price is going to be fought on specific patch of ground. And you need to know exactly where landmines are buried. Take a piece of paper. Write down 3 numbers, 74, 88, 60. These are only numbers that matter right now. Everything else is noise. Everything else is just algorithms hunting for liquidity in dark pools. Let me start with most important number on board, $74. This is line drawn in sand. This is bottom foundation of right shoulder we discussed in opening section. Technically, this level represents 61.8% Fibonacci retracement of recent move higher. It's mathematical floor, where smart money is currently parking massive bid orders. As long as daily candle closes above 74, bull structure stays alive. Inverse head and shoulders pattern remains completely valid. We're currently trading at 75.3, so we're dangerously close to edge. If you see price dip to 74.5 intraday, don't panic. That's a test. Market probing for liquidity. But if you see sustained violation, if you see 4-hour candle close at 73, the pattern is broken. That's your red alert signal. Now let me discuss bull case scenario. If 74 holds firm, which our analysis strongly suggests it will do to physical buying floor established in China, then accumulated energy has to release somewhere. It will rebound back toward neckline. That neckline is sitting at $88. This is trigger mechanism. We've tested 88 twice before in recent weeks and failed both attempts. But third test is usually charm in technical analysis. If we break 88 with volume, there's effectively no resistance until all-time high near 121. Chart becomes vacuum, air pocket. This is where short sellers get squeezed into liquidation. This is where bears capitulate. So if you're operating as a trader with risk capital, you're watching for clean break above 88 with strong volume to add to position aggressively. But because we're not Michael Saylor and his cult of delusion, we must discuss bear case scenario with equal attention. What happens if seesaw in China dumps too much scrap metal into system? What happens if algorithms decide to flush market one final time before reversing? What happens if 74 breaks to downside? Then we enter trapdoor. Support vacuum below 74 is steep and unforgiving. We'd likely witness rapid, terrifying flush all the way down to head of pattern. We'd retest 64. Now listen very carefully. If we see 64 again, don't sell in panic. This is not stop-loss moment. This is backup armored truck moment. If silver trades at 64 in world where India is acquiring 13 million ounces, China banned exports completely, Turkey is vacuuming up every available bar, it represents greatest asset mispricing in history of financial markets. It's gift from market gods. It's moment where you liquidate jet ski, sell extra car, acquire physical metal with both fists, because 64 is cost of production for marginal mines globally. Below 60, mines shut down completely. Supply goes to absolute zero. So 60 represents hard floor constructed from economic physics. Here's tactical battle plan for rest of this week. We're sitting at 75.3. We're watching 74 like hawk watches prey. If it holds, we ride energy release to 88. If it breaks, we wait patiently for 64 and buy everything in sight with maximum aggression. Either way, final destination is identical. Only difference is route. One route is direct flight. Other route includes layover in purgatory. But both aircraft flying to same terminal. The moon. We need to conclude with final verdict. We've dissected this slam to 75. Studied chart and identified inverse head and shoulders, most powerful bullish reversal pattern forming in real time. Exposed China's seesaw, tax-exempt scrap dealers flooding market to hide empty government vaults. Confirmed tourists departed, leaving field for institutional whales. Examined crypto hubris, where leaders promise no downside while we prepare with discipline. The conclusion is clear. Drop to 75 was not crash. It was bear trap designed to shake you out before right shoulder completes. Smart money knows physical shortage is worsening. Scrap supply is finite and running out. They're using this lull to accumulate before price breaks 88 and triggers squeeze. You stand at crossroads. Path A, a panic, sell, chase crypto where Saylor promises no downside. Weak hands take this path, and history says they get slaughtered. Path B, hold with discipline. Understand 74 is floor. Recognize coiled spring about to release. Real money takes this path. This market is sanitized, leverage flushed, sentiment reset. Only people left comprehend truth. World is running out of silver. Seesaw delay is inevitable, but can't stop it. When scrap runs dry, price won't drift higher. It will gap violently. Duh. Your tactical orders for 72 hours? Watch 74. If it holds, structure is perfect. Ignore noise. Boredom is deception. Prepare for 88. That breakout changes everything. 13 days after 121, silver at 75.3. The right shoulder is forming. The scrap flood is temporary. The arbitrage still exists at $34. March delivery still threatens 82 million ounces of registered inventory. Samsung still locked La Parida mine output. JP Morgan still closed shorts at exact bottom. Nothing changed except sentiment. And sentiment is the fuel. When everyone's bored, when tourists leave, when weak hands capitulate, that's when smart money loads the boat. The trap is set. Weak hands eliminated. The pattern is forming. Stack now while 74 holds, or wait for 64 if it breaks. Either way, you're buying atoms at fire sale prices while the world runs out. Now you know the game.